Hello, investors. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And this particular video is going to be one that's covering something that I'm asked probably more commonly than almost anything else I'm asked. And that question is, what's the best valuation metric? And in addition to being asked which is the best valuation metric, I'm also quite often being told what the best valuation metric is. And often what we're really dealing with here are opinions rather than pure facts. And I like to live in a factual world. So what I tend to do with this video is talk about the many faces of valuation and how you can utilize all of the various valuation methodologies. And the reality of it is, I don't believe there is such a thing as the best. I think the real answer to that question is if you want to truly learn how to value a business, you want to utilize all the valuation metrics that are at your disposal. And additionally, we provide a great deal of those on FastGraphs already, and we intend to be adding more and more, and I'll be talking about that a little bit later here in the video. So let's go ahead and get started. Let's start by looking at a stock like Visa. And what I want to do here is I want to talk about, how to value a business, how we can know whether, the stock is fairly valued or not. But I also want to point out that valuation is also functionally related to what I like to call growth. Buying a stock at fair value doesn't necessarily mean that you're going to make a lot of money. It simply means that you're going to participate in the growth and the benefit that the company is capable of generating. So let me add a stock here before I go any further and try to give you a perspective of really what I'm trying to illustrate here. You can buy a low growth stock as an example. I'm going to use Southern Company here as my example. You can buy a low growth stock at an attractive valuation and still not generate a real high rate of return. So for example, looking at this as about a 16 PE, this is only a company that's growing at 2.6% over this time frame. So I'm just going to pick a time where I could have bought it at, let's say, right at that 16 PE and held it, this many years at that 16 PE, and I'd make an annualized rate of return of about 6.2%. But keep in mind, I'm getting a 4% yield over that time frame. So one valuation reference is simply look at the PE ratio or the price to earnings and then look at the earnings yield. Now, I like an earnings yield of at least 6.5%. It's the mathematics of valuation that's important. But visually, I can look at this graph and see that Southern Company is trading at one of its higher valuations over this, 20 plus year history here you're looking at. So that means it's probably not a great buy. Since it is a dividend paying stock, I would also look at things like dividend yield, and I'm going to get the highest dividend yield. This is a mirror image of the valuation or the price. I want to buy the stock when the dividend yield is high, like here it was 5.2%, when the stock was trading at only about 14 times earnings, or one of its lowest PEs on this time frame. I don't want to be buying it when the dividend yield is very low, about what it's at today, by the way, about 4%. Even though that's a high yield, that's still not going to give me a great rate of return because I'm buying the stock when it's too highly valued. Now, over this next 5 or 6 years, as it moved back to that orange line, I would have only averaged a 3.5% return. I'd have actually had a negative 5% loss. But the point is, I can see valuation and I can use the dividend yield as a valuation model. I can use the price earnings ratio as a valuation model. Now, when I got faster growth like a Visa, who's actually grown earnings at over 20% a year, as you can see here in the Fast Facts box, valuation isn't as critical as far as me making or losing money because of the power of the growth of the business. So here, even if I buy Visa up here on October at a PE of almost 30, which is, lower than it is today, I might add, but even if I buy it there, because the company's earnings growth has been so good, you can see as I go across here, and of course they had a COVID issue like everybody did, but I'd have still generated a rate of return in excess of 22% per year. Now, if I bring this scroll bar over and, kind of tie into the time frame here, we're dealing with the time when the company's growth was only 15.6%, but I went from being, trading at a normal PE of 30 here-ish, 29.4, to now measuring at a PE of 42.9. So I got this great rate of return, but the real principle that I'm referring to there is the growth that I actually achieved or that the company achieved on my behalf, even though it's currently overvalued. But now, what other valuation metrics did I have? Now, I've got a lot of metrics to choose from. I can look at GAAP earnings, okay, which are diluted earnings. And this is another question I get quite often. People are always asking me, how come my earnings numbers are so different than what they see on Yahoo? And, this would be a good example. Yahoo would often be showing diluted earnings. And I want you to notice there's a vast difference between diluted earnings or, what I would call GAAP or earnings with a lot of accounting convention than there are with the operating earnings. So here I'm looking at a normal around 30 times GAAP earnings, but it does give me a perspective of what might be going on in the business, but I don't consider GAAP earnings necessarily a great valuation tool. Now, another one that I do like quite a bit is operating cash flow. Okay, because especially for faster growing stocks, cash flows become very important. And you look at Visa here, we get a different perspective of its valuation when I'm looking at cash flows. The company's been, stock price has followed cash flows. And even here, although we had a dip in cash flows here, I've got the stock separated really for the first time on this graph, other than maybe for a little bit of time here, in 2016, where it's actually above, quote unquote, the price to operating cash flow valuation reference of 29 times cash flow. But the cash flow, the operating cash flow is expected to grow. So the point is, it is overvalued here based on cash flows. If I did buy it and it went and tracked normal cash flows like it has historically, I'd still make a positive rate of return. If I go to my forecasting graph, cash flow is expected to grow at 24%. Over the long run, I could make 7 or 8%, but I'm not making 24 or 25%, which I would be making, just to be clear, if I was buying the stock when it was trading, at a valuation that was in line with its cash flow. Then if the stock traded out here, I'd be making that 20% rate of return. So again, this is another way to value the stock, is to look at operating cash flow. Another one I like to look at, especially with dividend-paying stocks, is free cash flow. So I'm going to look at the stock relative to its free cash flow generation, and I get a very similar picture here as I did with operating cash flow in the case of Visa. So, the stock, because of the powerful growth expected here, this company doesn't look so bad. So I'm utilizing several valuation references. Finally, let's go to EBITDA and just look at Visa's normal price to EBITDA over the time frame since it's been public. Now here, I get another perspective. It's normally trades at around 17.5 times EBITDA. And so now I've got it at 32 times EBITDA. We'll call that almost twice its normal EBITDA valuation. That would indicate that the stock now, once again, is very, very highly valued. And so I've gotten, all these different perspectives, but I'm using all of them and thinking about all of them. My dividend yield perspective says this is a bad time to be buying Visa because my yield is lower than it would be if I was buying it when it was trading at a rational valuation. So there's many, many ways to look at valuation. Now, again, with faster growing stocks, I've also got another option here that I might want to look at. I might want to look at something like price to sales, okay? Because price to sales gives me another valuation reference. Is this stock trading at a normal price to sales? Now, what you see here, if you focus on the blue line, I'll even take the sales off, around 12 times sales would be attractive. I'm at over 21 times sales here, so I would consider that obviously fully valued, but I do have very strong and very consistent sales. So I might want to take a deeper look at that because all I'm trying to do here is look at all the different ways that I can value this business. So I would go into the ratios graphic here in Fund Graphs, and I would look at valuation ratios, and here's my price to sales. All right, so this is one of the highest prices to sales that the company has traded at historically. I'd much rather be buying it at 6 or 7 times sales or 8 times sales than I would at 20 times sales. Okay, so I'm looking for all these various different valuation references. If I look at enterprise value to EBITDA, which is a metric we will be adding to the core fast graphs in the metric column that I've shown you here on these other stocks, we'll be adding to this list. We'll be adding price to sales here, but we'll also be adding enterprise value to EBITDA. So if I look at enterprise value to EBITDA for Visa, I once again see that I've got a very high enterprise value to Visa. Now, having said that, my conclusion is real simple. Visa is an overvalued stock, but it's an overvalued growth stock, which means I can still make money investing in Visa, but I have to then challenge myself and ask the question, should I be paying this premium valuation for this stock, even though it's a phenomenal stock and a phenomenal growth stock? Okay, but then you also run into other challenges with valuation. When you're looking at stocks that are very cyclical, like Goldman Sachs, you got to be careful here. I've got a very strong earnings yield of 8.51%. If I run it through the dividend model, I've got a very high dividend yield, even though it's only 1.37%. It's high relative to its historical norms. Here's only 1.9%. So when the dividend yield is high, that means that I'm, paying a higher valuation than I should be. But that is somewhat predicated on the fact that the analysts are expecting this powerful 75% surge in earnings, which is also driving the price up. But I want to take into consideration what this future expectation will be. And of course, ultimately, I'm going to go to the forecasting calculator and look at what I believe I would be able to make in Goldman Sachs. But again, that's one way to look at the stock. That's another valuation methodology. Now, this is very, very interesting and something that we're being challenged by. Our team is challenged by. We've been looking at names like Procter Gamble, Coca-Cola, PepsiCo, Colgate-Palmolive. I can go right down the list, some of the best brand names, and especially in the consumer staples sector that are really perennially fully valued. In other words, if you look carefully at this graph on Procter Gamble, we've got a 6% grower here, 6.62% to be precise over this time frame. We've got a stock that generates about that rate of return. If I measure it to, this normal value to this normal value, I've got a 7.4% rate of return, including dividends, which is consistent with the company's growth plus a little dividend yield. But here's the thing. Why is there this separation in this example versus others? Well, we believe the answer is brand value. This is a very powerful company, has a very powerful brand. You would see a very similar thing here if you looked at Pepsi, or a very similar thing if you looked at Coca-Cola. So what we're trying to do is quantify. We're not sure we can do that, whether or not we can give brand value a premium valuation. But having said that, the point I want to make is when you're looking at this premium valuation, and here's a stock that normally trades somewhere around a 20 multiple, 19.96 is the actual number, but these numbers are always ish. So if I go into forecasting and I look at the normal multiple, and here I've got 22, I might try to find it where I get it down to that 20 number that, I saw here realistically. I'd be looking at very weak rates of return going out over the next 2 or 3 years, because even though the stock is always traded at a high value, it's trading at a much higher value than historical norms. And again, this is factual information here because this is reality. And of course, when I'm dealing in the light shaded area here or in these forecasting tables, I'm dealing to a great deal on what the future might bring. But my point is, this is not that great a performer in the first place because it doesn't grow very fast, but it has commanded a premium valuation, I believe, significantly relative to its brand value. The stock has a great deal of brand value. And again, I could do this with Coca-Cola. I'm going to draw Pepsi here for you now. But I can do this with a lot of these stocks that have really good brand value. When I look at this, though, I still see that my upper limit would be around this 20-ish times earnings. The actual calculation is 21.8, and Pepsi would be a little high here. I can also look at it from the dividend point of view. And, I've got a 2.95% dividend yield. And right now, the dividend yield is getting down there below 2.7. It's at 2.95, but it's below the times when I could buy this stock when it had a 3% yield, which would be the times when the price is most attractive. I want you to see that here. That would just be a valuation model or valuation indicator. But watch as I run this through some of these other metrics. Now, when I go to operating cash flow is what really gives stocks value. I really like cash flow as my favorite valuation metric at all. But I also want to look at earnings because earnings are what the market sees and what the market's always reporting. But if I look at Pepsi from an operating cash flow point of view, I can see a very high correlation here between price and cash flow. But I also see that most of the time I can buy this stock, at least since the Great Recession for sure, at a reasonable valuation. But now I'd be paying a much higher valuation. But once again, I've only got 5 or 6% growth here. And if I look at my performance, I'm only getting 5.8% 3.4% capital appreciation, I get up to a 6.7% rate of return because of the dividend and the growth of the dividend, okay, which is the light green shaded area on the graph. So, but my capital appreciation is going to be correlated to the growth rate of the company itself. But again, I'm going to look at companies like Pepsi or any of the ones I've shown you here from all of these valuation metrics. A lot of times when I do these videos, I only report with one metric. But the reality of it is I've got all of these other metrics at my disposal, including things like price to sales, the dividend model that I've shown you several times before, where I can look at valuation, because the key is that when I'm looking at future value, it's very esoteric. Historical value is pretty well defined. I can see what the company's valuation has been historically and make judgments based on that, but then I still have to come up with a way to forecast the future. But so at the bottom line is, what's the best valuation metric you can utilize? My answer is all of them that are at your disposal. You want to look at a company in every which way you can, because each one of these valuation references can give you a little different perspective. But I also encourage you, when you're doing that, run the numbers out to their logical conclusion. Because even if you look at a super company, let's go to Honeywell. Let's look at Honeywell. If I shorten this time frame, I see Honeywell's been about a 9% grower. I've got a much better rate of return. But if I'm looking forward, and it goes back to, it's always been a 15 times earnings company, or quite consistently. It's only been these last few years where we've been in this raging bull market where the PE has got above that. So if I assume that this is going to eventually revert to the mean, I could actually lose money owning this stock. But having said that, if I contrast that, like I did earlier with you, with a Visa, which is a very fast-growing company, I can overpay for the stock, but because it's expected to grow so fast going forward, over 19% a year, I might still actually be able to make money investing in this stock, but I'm not going to make as much money as I deserve to make. Now, if I assume a normal multiple of 30 as my multiple, and I look at this growth, and I can get to 27 here, here's what I mean. I could make 7, 8, 9, 10% a year, but I've got to have the market giving me this premium valuation, and I've got to get this high rate of growth for that to happen. But the point is, I can look at stocks differently from not just the valuation perspective, but value plus growth, because that's where I'm going to make my money. And my recommendation is run the numbers out to their logical conclusion. Don't just rely on the statistics themselves. Make sure you understand what those statistics are relative to: past growth, future growth, future expectation, et cetera, and then go through all the different modalities that you have at your disposal to evaluate valuation, so that you get a clear picture in your mind whether this stock is actually worth your money investing. Visa is clearly a winner if you can buy it at an attractive valuation. It might not be so much if you buy it when it's overvalued. Anyway, it's been Chuck Carmel. I hope you enjoyed this video on what's the best valuation metric. The answer, of course, is use all of them. Look at a company every which way you can to try to come up with a clear idea of not just what the valuation is, which is critical, also what the potential growth of the business is, and then whether or not that combination provides you a rate of return that will compensate you for the risk you're taking. Thanks for watching. If you liked the video, give me a thumbs up, ring the bell, subscribe to the channel, do all those wonderful things, and look forward to talking to you again real soon. Thanks for watching.